policy group across Mercer, and probably relevant to today's session. That includes leading the actuarial team at Mercer and being the actuary to a number of the large public sector defined benefit schemes. So I'm delighted to be able to host this session today on risk management of defined benefit funds in Australia. Before I hand over and introduce you to the team here, I'd just like to do an acknowledgement of country. As we're all probably in various different parts of both Australia and New Zealand, I'd like to acknowledge the traditional owners of all the land across Australia and New Zealand on which we are gathered, and pay my respects to the elders past, present and emerging. As I say, today we're covering the risk management of defined benefits, and I'm grateful to the team here at Challenger who are going to work us through this today. In particular, focusing a little bit on the background in DB schemes in Australia, but also then delving into the various stakeholders and the interest that they would have in defined benefit schemes, the risk management options that are available, and run us through some examples there. And also then touch on some of the experiences that come through from the UK, where there's, I'm sure many of you will know, there's a very large developed market in this area. So without further ado, I'll introduce you to our speakers today. First up is going to be Oscar Chen, Senior Product Actuary from Challenger and Fellow of the Institute. Spent over 10 years developing and working in the life insurance industry, developing products and pricing for risk business and retirement income products. So welcome, Oscar. Then we've got Nikita Chelani. Nikita's a senior actuarial analyst at Challenger, specializing in development and pricing of retirement income products. And prior to that, 5 years at Willis Towers Watson, with a focus there on large defined benefit schemes. Mahir Edibam is going to then pick up. Mahir is a senior manager in the institutional client services team and responsible there in building the solutions for a whole range of clients. And Mahir's over 18 years experience globally amongst a number of institutions, both in the US, UK and Australia. So we'll share some of the experience built up over that time in this area with us. Finally, we've got Anton Kapel, the CFO Life and appointed actuary with Challenger and previously chief actuary at AMP, having spent about 20 years in the consulting side of the fence, I think it is, Anton, with Tillinghast and the successors there. Given Anton, I believe you're going to leave the presenting to the others. All the hard questions are coming your way, I think, at the end. So maybe to kick us off, though, if I could hand over to Oscar, please lead us off. Sorry, I should just say before I do hand over to Oscar, we've got the Q&A function, so please add Q&As as we go through. If you can type them into that Q&A box, we'll monitor them as we go through. We'll probably pick them up at the end, towards the end of the session. If there are any particular that jump out to us as we go along that might get picked up, we'll maybe throw them into the mix as we work our way through. But please just enter those Q&As as they come up. So Oscar, over to you.
Thank you very much, Richard, for the introduction. Hi, everyone. Thanks for joining us today, and good afternoon to you all. This is today's agenda. I will first give you a brief overview of defined benefit funds in Australia. Then Mahir will take us through the key risks faced by DB fund trustees and sponsors, as well as some common risk management strategies. Nikita will then illustrate with a case study of some risk management approaches. We will close the presentation with a touch on some risk management strategies for UK DB funds. Okay, so let's start with an overview of DB funds in Australia. The chart on the left-hand side shows a 5-year history of DB member benefits, which represents the present value of expected future benefit payments to defined benefit members and their beneficiaries. It can be seen that DB member benefits have steadily increased over the last 5 years from circa $280 billion to $326 billion in 2019. However, its proportion of total member benefits has reduced from approximately 19% to 16%, reflecting a faster growth of defined contribution member benefits over the years. The chart on the right-hand side demonstrates the DB market by fund type. As you can see that public sector funds account for the majority of the member and member benefits, which is about 96%. Over the last 5 years, the proportion of DB member benefits held by members aged 60 plus has gradually increased from just under 40% to approximately 50%. That's shown as the blue color here. This group represents members who are close to or have already reached their retirement age. The increasing proportion of member benefits also indicates that more and more funds are maturing and entering into pension phase. There can be complex features and risk considerations of each individual DB funds. And before we move into further discussions of the risks, I'd like to invite everyone to do 3 quick questions. Question 1. Thinking of the funds that you are closest to, what do you consider as the key risks that are faced by the trustees and corporate sponsors of the defined benefit funds? I'll give everyone notes that this is a multiple choice question, so you can select more than one answer. Okay, once you're ready, let's have a look at the results together. Cool. All right, so I think we have how many? We have about 47 participants today. So 19 out of 25 of you have chosen market volatility. That's include equity and bonds volatility as the top one. CPI inflation, wage inflation, which are probably not surprising. And it's good to see a lot of people recognize longevity risks as one of the major risks faced by trustees and corporate sponsors. A couple of other options ranked a little bit behind on pension take-up rates and regulatory risk. Okay, let's move on the second question. So thinking of the funds that you have considered, identify the key de-risking activities that the fund has or have undertaken. So we have listed some what do we believe the common de-risking activities. So thinking of the funds that you have considered, it could be related to question 1. What sort of activities, de-risking activities have you seen? Again, this is a multiple choice question. All right, let's have a look at the results. Waiting for the pop-up. Okay, it is sort of a spread everywhere, but I guess the top one is de-risking investment strategies, close to new member DB to DC conversions. We do see some other de-risking strategies such as longevity swap, annuity buying, buyouts. That's more related on the insurance strategies. Okay, we'll comment on some of these strategies and results in later on sections as well. But third question, thinking of the fund you are closest to, what is the approximate proportion of liabilities of DB member benefits that are associated with pensioners in payments? So we have listed out some options, some proportions for you to choose from. This is a single choice question. All right, this should be quick. Let's have a look at the result. Cool. So we have about 40%. People have chosen 50 to 70%. That suggests from the audience, lots of the funds that's they're considering. Do you have quite a reasonable proportion of liabilities associated with pensioners' payments? We do have the second highest, which is clearly those funds with less pensioners in payments. Okay, cool. We do recognize throughout our research and analysis, and to some extent, consistent with what we saw just now, that there are limited industry-wide data available for membership categories splitting DB funds. Accumulation members still represent a significant category in many DB funds. Nevertheless, we consider that the significance of pensioners will grow over time relative to active members of funds with pension benefits. I think the proportion was, based on the audience we have today, is a pretty reasonable proportions already. Pensioners in payments should be considered as a distinct sub-fund. Although there may not be many funds in this group now, maybe true from a wider group perspective, there will be more over time, and it will be useful to think about those solutions to this problem for any fund with pension benefits. So from here on, we have focused our discussion on funds that have only pensioners in payments, and I will now pass it to Mihir to discuss about the risks and de-risking strategies.
Thank you, Oscar, and hi, everyone. As Oscar mentioned, for today, the risks we will focus on will be only for DB funds and pension. Now, from a trustee's perspective, the main risks that they'd be concerned about would be the members' best interest and making sure that the members' accrued benefits are protected. But for defined benefit plans, there are a range of risks that are borne by the corporate sponsor and the fund trustee. So for today, I'd like to highlight 3 areas of risks, starting with longevity risks. With life expectancies increasing, looking at the Australian government actuaries suggested best practice, current life expectancy with improvements, as we would all know, for a 67-year-old male would be 20.4 years. With improving longevity, could put a strain on the sponsor in meeting these liabilities with a very long tail, as articulated by the poll as well. Another key risk would include investment risk, which encompasses the volatility seen in equity and credit markets, along with interest rates being at historical lows, can put pressure on the funding levels for the corporate sponsor. For today, the last key risk I'd like to articulate would be regulatory and administrative risk. Even for DB schemes that would be potentially closed to new members, the long-term nature of the risks may continue to sit with the scheme and sponsoring employer for more than 30 years. There is a stringent requirement on governance and management, including actuarial responsibilities and obligations relating to the fund. Operationally as well, the sponsor would need to make sure that their systems and administrative platforms remain up to date and compliant. Therefore, beyond just ensuring that the scheme is fully funded, there are also administration and actuarial considerations, as well as the need for ongoing management to focus on that can create a long-term burden on the corporate sponsor. The next slide that I wanted to touch on is basically looking at the strategies that defined benefits could consider when thinking about de-risking or defeasing their pension liabilities. At one bookend, we've got the glide path approach, where the DB fund incorporates a de-risking strategy, which they could achieve by locking in their gains on their asset pool, therefore reducing the risk of the sponsor contributing, as well as decreasing their funding gap, if they would like to eventually move to defeasing their pension liabilities with an insurer. In this option, the employer would still manage and monitor the implementation of the glide path and carries all the risk. The next option would be a longevity swap, where the fund would agree a schedule of payments with the insurer to move the longevity risk from the fund sponsor, as the fund sponsor would be covered if the pensioners live longer than expected. This is only a partial reduction in the risk, as the fund would still have to manage the ongoing investment and retain the obligation of meeting the pension payments for the members. Now moving on to the other options where the member relationship is transferred to an insurer. With the buy-in, the trustee purchases an income stream from an insurer to match their pension liabilities. In this option, the investment and longevity risks are outsourced to the insurer, but the fund retains the investment and pension fund administration, while as the trustee retains their obligations and responsibilities. The last two strategies, which incorporate a buyout and a buyout via a successor fund transfer. Now, in both these options, the DB fund has made the decision to close the fund with no residual liability, moving all the obligations to the insurer. The main difference between the buyout and the buyout via an SFT is that a buyout could have a potential loss of grandfathering in a transfer balance gap reassessment. In a buyout with a successor fund transfer, while taking longer and incurring a cost given the complexity of moving all the pensioners to the insurer's retirement fund, in the SFT option, the member retains their grandfathering provisions and it may not and will not trigger the transfer balance gap. The last slide in my part of this presentation is to just consider these various strategies available and touch on what the risks would be diffused across the spectrum. This illustration, the three main risks we spoke about earlier, which include market risks, investments, and demographic, which includes the longevity risks, and operational risks, which include the governance and risk management obligations for sponsors. If we start at the top left, in the base case, if the defined fund with pensioners would retain their plan, the sponsor would carry all the market, demographic, and operational risks. Now, moving clockwise down the spectrum, if the fund were to apply some sort of investment de-risking strategy, like a glide path, along with the longevity swap, this would mitigate the market risk and remove their longevity or demographic risks. Now, the same risks would be diffused in a buy-in, the only difference being that the market risks are outsourced to the insurer as part of the purchase of the income stream. The last option, where the fund decides to close their DB pension liability with a buyout, is where the fund would have wound up all with no residual liability, therefore moving all their risks to the sponsor, from the sponsor to the insurer. I just want to hand over now to Nikita to take you through a hypothetical example on the impact of these risks in maintaining the fund.
Thanks, Meher, and good afternoon, everyone. So as Meher discussed, the key risks for a DB fund are the market risk, the demographic risk, and the operational risks. So this hypothetical example we'll be looking into will consider the impact of the market risk and to some extent the demographic risk in maintaining the fund. We'll then look into what would be the impact if one of the risk management approaches, which we've discussed earlier, was taken. So let's go back to 30th June 2018. We have 100 pensioners, previous slide, yep. We have 100 pensioners in the fund and there are no active members or accumulation members remaining. The average age of the pensioners are 75 and the total annual income payment is 6.5 million. The net assets available to pay the members' benefits are 85 million, and these are invested in a 75% growth investment strategy. Next slide. So the fund is a fairly simple design. We're offering a lifetime income stream with payments made monthly in arrears. These payments are indexed by movements in CPI on the 30th of June each year. The spouse is offered 67% income on the death of the primary pensioner for the remainder of the spouse's life. So the actuary has set some assumptions at 30 June 2018. We have an expected return on assets at 5%. This is before tax and after expense. We have a CPI inflation rate at 2% and administration expense set at 0.2%. This is deducted from the expected return on assets. The mortality assumptions is using the latest Australian life tables with 125-year mortality improvement factor. Given the high allocation to growth, the target funding level is set at 110%. So what is the value of the liabilities? On a funding basis, using the actuaries assumptions we've just discussed, the funding liability is 77 million. However, this basis incorporates a high level of risk and essentially assumes the employer has a geared investment into the assets of the fund. So what is the true value of the liability? Using a risk-free rate and a 5% rough allowance for a longevity swap fee, the risk-free liability is 105 million. So let's take a look at what we expect to happen over the next 21 months. we can see that the fund is 80% underfunded relative to the risk-free liability at 30 June 2018. The funding position, which is the assets over the funding liability, is at 110%, and we can see this trending towards an excessive surplus. In most trust deeds, we'll find that repatriation of the surplus to the employer is not common, and this will lead to many questions as to how do we manage the potential excessive surplus near the end game of the fund. So let's now look at what actually happened over the 21 months. The yellow line shows a significant volatility in the funding position over the period. We can see here a large deficit from the target funding in December 2018, and we're just meeting the satisfactory level. The employer is now required to top up an additional contribution to slowly bring the funding position back to the target funding level. Despite these additional contributions, we then see, after the March 20 quarter, the funding position has deteriorated and bringing it to an unsatisfactory position. This requires immediate increased funding of roughly $900K per quarter over the next 3 years. Now, while I understand the time period shown is A, a very short period for an analysis, B, we're looking at a time when there's been a bull market as well as falling interest rates, and C, the COVID impact in March 2020 is an extreme scenario and returns have come up since then. But this does paint the picture that there is a highly mismatched nature of the assets to the liability and exposes the employer to large unplanned cash funding during difficult times. The members' benefits are exposed to the risk of the employer ceasing to continue funding contributions. Go to the next slide. So when we look at this slide, we're looking at the main drivers of the movement in the reserves. So we've gone from an 8 million surplus to a deficit of 0.5 million. So despite the contributions in an attempt to bring the reserve to a target level, we can see here that the investment experience has been the biggest downfall. This is followed by the mortality experience as a result of no deaths during this period. So let's now look at the impact of some of the risk management approaches. We'll start off with the glide path approach. So as Meher explained, the approach slowly de-risks the investment strategy to a more defensive strategy over a time period. In this example, we've gone from a 75% growth allocation at June 2018 to a 60% growth allocation in March 2020. As a result of the de-risking investment strategy, the expected long-term return and the volatility of the investment returns lowers. With this lower risk, we no longer need 110% target funding level, so that can come down as well. So from this chart, we can see that the target funding position has come down. The funding position, despite the positive returns in September 2018 and June 2019, has declined or remained relatively stable due to the increase in the funding liability value. The volatility in the funding position is still there, but it has come down. The additional top-up contributions has come down significantly. However, as a result of missing out on the upside risk, there has not been sufficient amount of return on the reserves between the June 19 to December 19 to maintain the fund at a satisfactory level in March 2020. So this shows that while this approach will be beneficial over the longer term, the fund is still exposed to some extent of market and demographic risk, as well as the operational risk in maintaining the fund. So this chart shows that the drivers in the reserves are still the investment experience and mortality experience. However, comparing to the previous drivers chart, we can see that the investment experience impact has reduced by roughly 20%. We also see a new driver being the change in assumptions. This has an immediate deterioration on the funding position. Over the long run, the de-risking approach will bring the funding liability value closer to the true value. Not exact, but somewhat closer. So this approach can be the short-term strategy before considering a buyout and closing the fund. So what if we did an immediate buyout on the 30th of June 2018? So going back to the comparison where we had the funding liability and the risk-free liability, we can now bring in the annuities. We can see here that the purchase of the annuities which is offered at a margin over the risk-free rate, will remove all the market, demographic, and operational risk at a lower value than the risk-free liability. So while yes, we still require an 11 million contribution by the employer to cover the shortfall in the assets, the fund can be closed with all risks removed and the member benefits are more secured and backed by a regulated life insurance company. So while a buyout will impact the members in regards to the loss of grandfathering of social security treatments, an SFT buyout will have the same impact with no loss of grandfathering provisions. So it can be understood that 11 mil is a significant amount to ask from an employer. So we can look at an alternative approach by doing a staggered buy-in. In this particular example, we've done 2 sets of an annuity buy-in. We've done an annuity buy-in in June 2018, roughly 10% of the liabilities, and in June 2019, which is an additional 6% of the liabilities. As a result of these buy-ins, we're seeing an immediate deficit on the funding position at these 2 points. We do, however, see a lower volatility in the funding position and reduced top-up contributions required. Over the long run, we should see the liabilities that are backed by the annuities protect the fund from an investment and longevity risk. This staggered buy-in approach, and can also be a staggered buyout approach, can reduce the immediate cost to the employer and can be used to slowly match the assets to the liabilities and close the fund. So while this example is fairly simplistic, the intention is to raise some important questions for you to consider. As active members move into the pension phase, what are the employers' and trustees' thoughts on how to get to the end state solution? In Australia, we have been lucky to see employers continuing to contribute to these funds. However, as they mature to a pension pool of ex-workers, the question remains as to how long the employers will still be supporting these schemes. Will they still be willing to retain the market, demographic, and operational risk for the ex-employee benefits? Is the regulatory environment discouraging de-risking in Australia? We're seeing that buyouts are less common because of the loss of grandfathering provisions. So does this suggest that we need a change in our legislative and regulatory environment to allow for a more smoother process? And what evolutionary solution can we start to see in Australia? The UK has recently come up with a new solution to address the increasing employer covenant risk. But will this solution be appropriate for Australia? Oscar will now touch on this solution, as well as other risk management strategies in the UK. I'll hand it over to Oscar.
Thank you, Nikita. Yes, we have gone through some questions of the risks and risk management approaches in Australia. It is also an interesting angle to look at what are the practices overseas. UK as being one of the biggest pension markets in the world, it's in 2019, according to the data we have seen, that UK defined benefit assets has reached to a size to approximately 2.2 trillion British pounds, or in Australian dollar sense, that's approximately more than 10 times of the Australian DB market. According to a survey conducted on UK pension plans, significantly higher proportion of plans were cash flow negative. That is when the plan has matured to the point that regular outgoings to meet liabilities exceed income from investment and contributions. As you can see on the pie chart on the left, this proportion increased to a 73% in 2019 as compared to 66% in 2018. The most common method to address this negative cash flow problem is via disinvestment of equities to more defensive assets, such as bonds. As can be seen in the chart on the right-hand side, the strategic asset allocations have changed significantly over the last 15 years. For illustration purpose, I have grouped equities with property and alternative investments into equity and other. As can be seen, the equities and other proportion reduced from circa 65% to 45% over the last 15 years. In 2019, the equities and other consist of about 21% equity 22% alternatives, and 2% property. For your interest, this non-bond proportion was as high as about 88% back in 1989. So what is the strategic journey plan taken by a lot of those UK funds? In UK, because many plans have been closed to new entrants and future accruals in recent years, when, as is often the case, a plan is underfunded, a journey plan is designed to align investment strategy with the gradual recovery of funding position. The proportion of DB plans that have defined a specific long-term funding objective that is beyond their technical provisions liabilities has increased over the last 5 years. As you can see from the chart on the left-hand side, the objective typically includes either the transfer of plan liabilities to an insurer, in this case a buyout, or a self-sufficiency strategy, also described as a run-off strategy. Over the last decades, the UK pension de-risking market has actually been very active. The chart on the right-hand side shows you the buying and buyout transactions that have steadily grown to about 44 billion British pounds in 2019, which is about 9 or 8 times more than it was about 10 years ago. Some recent research suggests that even during COVID-19 in 2020, the market remained open for business, and with March and April seeing some quite attractive insurance pricing, driven by widening UK and US corporate bond spreads relative to UK gilts. As you can see on the chart on the right-hand side, the transaction size have gone up tremendously over the last decade. However, we all know that it is also the periods when interest rates keep going down. So it does suggest that low interest rate environment has really not been an obstacle to the buying or buyout activities. In cases of the self-sufficiency strategy, a closed plan continues to meet member benefit payments directly as the liabilities run off over time, rather than transferring them to an insurer. As a result, some elements of investment risks will still be retained. The chart on the left-hand side shows that for those funds which set a self-sufficiency target, what is the range of associated basis on which the liabilities are valued by them. It can be seen that the liability valuation basis largely represents a very modest premium above the risk-free rate, with close to half of the plans value their liabilities even using government bond plus about 50 bips, and most of the other half using a smaller margin. When compared to transferring to an insurer, the buying buyout pricing may still be considered favorable than holding gilts in the UK sense, depending on how corporate bond spreads move relative to the gilts. The chart on the right-hand side shows the time frame for de-risking strategies taken by the funds. The number of plans that are looking to de-risk within the next 10 years has increased from about 58% in 2018 to 68%, from 58% in 2018 to 68% in 2019. This could be potentially as a result of the increased volatility back in 2018 and an increase in bond yields leading to improved funding positions. The UK DB market is more than 10 times the Australian DB market. Although there could be many differences in terms of funds and member profile, investment environment, and regulations, it can be clearly seen that de-risking as they march towards the end game has been a common theme. What UK DB funds have been experiencing could certainly give some useful implications to Australia. To many of the UK DB funds, their funding strength and employer covenant affect the de-risking strategies and pathway they would take. As shown on the chart, for those funds at the low funding level and weak employer covenant, the Pension Protection Fund, or PPF, becomes the safe harbor for their members. But for the majority of UK DB funds, a very new consolidated model, as mentioned by Nikita early on, called a super fund or super fund consolidator has been introduced. So what are they? Super funds are consolidated schemes set up to accept the bulk transfer of assets and liabilities from other DB schemes. The transfer typically involves an initial capital injection by the employer as well as some third-party investors. There will be a trustee for the super fund, which replaces the trustee responsibilities of the seeding schemes. The super fund consolidators claim to have better efficiencies and economies of scale than the source schemes, and typically require a smaller asset base than the price of an insurance buyout. However, there could be fundamental issues with this model. For instance, the super fund consolidator offers a significantly lower level of benefit security than an insurer, as the capital that the super fund consolidator holds is far less than what an insurer is required to hold. Also, the support of corporate sponsor is lost, being replaced by the super fund consolidator. Thinking in the Australian context, the super fund consolidator model is unlikely to be considered appropriate, given the legislative environment here, and there's a less appetite for risks to member benefits here in Australia. To wrap up our presentation, as we have mentioned earlier on, there are various financial and non-financial risks faced by the defined benefit trustees and corporate sponsors. Regardless of about their membership profile of each individual fund, whether a majority of the liabilities belong to pensioners, impairments, or active members, it is crucial to understand the fair value of liabilities after taking into account all risks exposed to the fund. As we see from some statistics of the UK DB fund activities, long-term de-risking planning is very necessary, and plans of any size should consider suitable de-risking strategies to strengthen the member benefits security, and or seek for options to provide operational and administrative benefits to them. It may be appropriate for all trustees and sponsors to consider and target a fully de-risked position over a horizon shorter than the life of the underlying benefits. That is all about our presentation today, and thank you for listening, and I think we're now open for questions.
Yeah, thanks, Oscar, Nikita and Meher. That was great, and a lot of interesting insights. So hopefully that gave, I see we've had a few questions coming through here, which we'll work through, but so I'm sure it's given plenty for people to think about. And if you can just add in your questions to the Q&A box, we'll work our way through. And I know, Oscar, we were getting a bit of crackle, I think, on the joys of doing things over Zoom. So if there are any things that people didn't pick up, particularly on that last section from Oscar, please add it to the Q&A, and we'll work through. I will make a start, and as I promised Anton that we'd give the hard questions to him, maybe if I can come to you first, Anton. And I think there's a few interrelated questions here, which really around the funding, and what is the appropriate funding level. One question specifically, maybe to start with, is around, is there a regulatory requirement on funding levels in Australia? And I think that then links into, maybe if you can follow through then, the question at the top, which is most DB funds in Australia are quite well funded. So I guess in the context of that, if you could link the two of those together, and then the comment being that it's difficult to not only educate employer sponsors of the underlying DB risks, but also to persuade an employer to provide additional funding if they're looking to execute these. So maybe Anton, if we could start there, I think that picks up quite a few of the items.
I guess I'll start with a comment around valuation techniques, and basically point out what I hope is obvious to everyone, that different techniques serve different purposes. And super funds in Australia, their sort of primary funding valuations are undertaken in the context of an employer standing behind the fund and being willing to contribute to it, so that ultimately, when all the fund's liabilities have run off, everyone's been paid. That's a type of valuation that serves a purpose, and the particular purpose is a smoothed contribution rate over time, given a range of assumptions. It doesn't give a value of the liabilities at a point in time. So the key issue is around the discount rate that's used. And funding valuations are undertaken using a discount rate that's based on the earning rate of the assets, which, as I said, it's appropriate when you're setting your best estimate of what you think the employer is going to have to contribute over time, but it's completely inappropriate if you're trying to value the liabilities today. So I guess there's a regulatory basis that allows you to look at funding from the perspective of an employer standing behind the fund and being willing to contribute through to the sort of ultimate wind-up of the fund. And that's, as I said, that's a basis. But if you're looking to remove the employer's risk, that basis doesn't give you the right measure of liabilities.
Yeah, thanks, Anton. I think that's one of the key elements here, and I think probably as alluded to in the statement, that actually identifying and outlining all those various different risks to the sponsors actually in itself is a challenge to when the funding standard may be showing that they're 100% funded, for example. That's a challenge to work through those points, and maybe the example that Nikita showed or similar could be ways to do that. I guess on a similar point then, and maybe this, maybe Nikita, you could answer this one as part of the staggered buy-in, buy-out approach. But the question here essentially is saying, doesn't this expose the sponsor to adverse market movements between the transaction dates? And the second transaction may not actually even occur. So apart from cash flow limitations from the employer, what are the factors would lead trustees to prefer the staggered buy-in approach?
Yeah, so we would see the employer and the sponsor being exposed to the adverse market experience, but during the tranches between the two buy-ins. But we will also, and a majority of that example is mostly looking at the cash flow limitation for the employer. We had the 11 mil upfront if you were doing the immediate buyout for the whole portfolio, but if you start to do it just for a section of the portfolio, it will reduce that immediate cost. So that was from a perspective of the cash flow funding. But yeah, you will be exposed to market risk, and potentially could be exposed to positive market risk. Interest rates could move up by the time you get to your second tranche, and you could have a more valuable purchase of the annuities over that time. So you are currently exposed to market risk under maintaining the fund. But with the buy-ins and with the staggered buy-ins, you are reducing that level of market exposure.
It ultimately comes down to the employer-sponsor risk appetite. So, they are running a risk. If they're comfortable with that risk, then they can take whatever time they want to effectively remove that risk. But if they're not comfortable with that risk, then they should be doing that as quickly as possible.
Yeah, that's right. And I know, as Oscar had given a number of examples from the UK, that there's a variety where it comes down to affordability as well. I know a number of schemes that have partially done a buy-in and then come back several years later and secured the rest of the policy. So yeah, it's a number of factors obviously being taken into account there to do that, and gradually removing that exposure. And I guess maybe extending on from that, Mahir, maybe could I ask, given what we've just heard there and the challenges, how could a corporate sponsor justify going down that buy-in route?
I think it's a common question we get in our discussions with sponsors and actuarial consultants as well. I think once you accept that what the real value of your liabilities would be, and and how if the sponsor actually wants to not carry that risk anymore because it's not part of their core business proposition, and actually challenge that, I think that's something that would steer them towards the buy-in route and make it more compelling as well when they look at what the true value of de-risking actually is. It's quite it's a higher value that they'd get when they actually look to de-risking with an insurer than actually what they would consider a risk-free valuation of their liabilities.
Yeah, so a lot of that I think seems to come down to this balance between the risk trade-offs, the costs, and how the corporate is comfortable with managing and where to take those risks, and ultimately, I guess, coming down to understand what those risks are that are being run. And we focus there very much on those with pensions liabilities. There's a question here, which is there a potential to do a deferred buy-in or a buyout for a cash balance scheme? How does this differ to the more traditional life insurance product? I'm not sure who wants to have a first go at that. Anton's come off mute, so maybe.
I guess it all comes down to what risks are being transferred. I'd say there are very few insurers around the world who would take exposure to final average salary risk, as an example. But there are plenty of insurers who would be willing to take the investment risk element of that, obviously priced appropriately, and potentially sort of certain other demographic risks. Exact timing of retirement could be one that some insurers would be willing to take. Other insurers may be less willing to take. If there's a lack of willingness to take those risks, you can use formulaic approaches to leave that risk with the fund, but sort of transfer the bulk of the risk that the fund wants to get rid of to an insurer.
Yeah, sure. And Anton, I know, as you say, certainly a deferred buy-in is something which has been looked at and secured, particularly in the UK market. It extends the term of the period over which you're, exposed, I guess, or trying to lock in the investment risk. Now that's for someone before retirement. Any comments around that in terms of the pros and cons to using the deferral period to then ultimately buy in? Is there a benefit to trying to lock in terms early, or does the extra time period actually introduce additional costs and risks?
I guess from the insurer's perspective, longer term, you're locking up capital for longer periods, et cetera, et cetera. So there is a cost to doing that. From the sponsor and the fund's perspective, if you want to get rid of that risk, then you are carrying a risk if you don't get rid of it. That becomes a risk trade-off question. If you're willing to pay the price to sort of get that risk off your balance sheet, you can. If the price looks too high to you, you don't have to. But as you said, some funds do this, some funds don't.
And I suppose then the other question we've got here, are there any examples in Australia of a buy-in in combination with a SFT process? I'm not sure. Oscar, is this in your research? Have you identified those which have done this?
I'm here.
As far as I've seen, Richard, in Australia, I haven't seen a combination of a buy-in and an SFT. I'm just trying to think of a scenario where a fund would want to incorporate both those options, because we usually see the buy-in being, a solution when, say, they have an active pool of assets of DB members as well, and a buy-in seems a way for alleviating that longevity risk component while keeping the fund with them. And so an SFT is usually when they just want to close their obligation down.
Yes, and I think that would be my experience that yeah, when you actually come to that insurance contract, it's usually at the time of closing the scheme down. I'm not sure if there are others online who may add to that comment in the Q&A panel, but
I'd be interested in hearing about
yeah.
you know, if it actually has taken place.
But you certainly see in the UK that, you know, buy-ins are often a step towards a buyout. Mm-hmm. So, you know, it comes down to the degree of, or the range of the risks that are being covered by the insurance. So a sort of investment matching strategy with longevity cover, you know, can be achieved via a buy-in where you keep the fund running. And then when you want to shut the fund down, to turn that into a buyout is, you know, relatively simple in that you've basically got the relevant investment assets in the fund. Then the question of whether it's a straight buyout or an SFT, when we've used the term SFT in this presentation, it's as a form of buyout, but rather than you know, a sort of traditional buyout where you're simply making the pensioner an annuity customer of an insurer, you're using an insurer's super fund vehicle to preserve any grandfathering considerations for the member. So to the extent that there are, you know, buy-ins followed by buyouts, if there were grandfathering considerations in place, you could do a buy-in followed by an SFT.
Thanks for that, Anton. And apologies, the dogs are probably about to start barking. Again, I think it's a point that we've sort of touched on, but whether it's expand further, there's a question here that says, do you think actuaries are not helping employers and trustees understand the value of their liabilities? PS 400 requires discount rates based on expected earnings and does not require reporting of the liability value, by which I think, you know, that's talking about the risk-free rated value, I think. And I know obviously from experience that's a very common breakdown to include in UK reporting. So maybe, I'm not sure who would like to take that and comment on that. If it's an extension, maybe Anton, of what you've been talking about.
Yeah, I mean, I'll start with that. So I'm old enough to remember the exciting times in the UK profession where there were almost sort of body blows in the Staple Inn meetings, where you had a sort of one side of the fence was sort of arguing for discounting at asset earned rates, and another, so on the other side of the fence, people were saying, no, you've got to discount fixed liabilities at risk-free rates. You know, I think that sort of argument was largely solved in the UK, in that, you know, I guess the whole profession in the UK became better versed with the concepts of market consistent valuations, and the fact that, you know, the value of a liability is independent of the assets supporting it, assuming that the liability flows themselves are independent of those assets. We perhaps sort of never got quite to the same state of conflict in the Australian market, and as a consequence, maybe we're not quite as good at highlighting to relevant stakeholders the difference between the two types of valuations. But I don't work in the field, so I'll defer to others who are closer to it than me.
Yes. Oh no. Look, I would similarly, Anton, live through those debates and the changeover in the way that things were valued, and I'd certainly say that I noticed that as a difference when I moved over to Australia, and I would think that is part of why it is hard to explain. And equally, though, why that might not have been explained, and I don't know, Oscar, again in your research here, that, you know, the markets in Australia compared to the UK are different, and a lot of it is around, you know, the relative size of the funds, you know, that pressure, and Anton, as you've said, breaking down the risks and understanding where they sit is far more impactful to employers and sponsors in the UK, maybe less so over here. Does that have anything to do with it, Oscar, maybe?
Yeah, I mean, we definitely recognize, you know, the economic scales or size of the funds that may have an influence on Sorry.
Sorry, Oscar. I think we might have lost you completely now. I could make out before, but I'm struggling on that. I'm not sure if others have helped Oscar with that research. They could comment on that.
Yeah, look, certainly I think the fact that DB liabilities are such a smaller proportion of the total means that there's less focus on it. And I guess also, the dynamics that there are fewer funds that are sort of genuinely struggling to meet liabilities is probably one of the other dynamics too that sort of takes attention away from the real underlying value of the liabilities. So yeah, there are multiple drivers, but I think the outcome of it all is that there probably is a little less focus than there could be on the actual value of the liabilities that the funds have. And Nikita made a comment that probably picked up from me saying it. In some ways, the sponsor is borrowing from the fund to take a punt on whatever risky asset mix the fund is investing in. So if you assume that the members are going to get their benefits, those benefits are, have a value at a risk-free rate because they are, if you assume the members are going to get the benefits, they are guaranteed benefits. And so any investment that carries investment risk is essentially the sponsor borrowing from the front fund and punting on markets. And is that the job of the sponsor? You typically won't see too many companies investing their working capital in equities. So why would they invest their super fund assets in equities?
Yeah, and I think that's the question to ask the sponsors, isn't it, Anton? They're maybe not always quite aware of that trade-off that they are taking. So that's the ultimate question to ask them, I guess. How comfortable are they with doing that? Mindful we've got 1 or 2 minutes left. Now, I've noticed a few of the other questions that have come through are around the nature of the statistics that, Oscar, you covered on the first couple of slides. So probably what I might do there is suggest that we might be able to incorporate some of the answers to those in the slides, which will then get uploaded onto the website, just to give clarity in terms of what's included and what's not included in those stats. Probably then maybe one final question to put, given that it's topical at the moment, is, how would you allow for future black swan events like COVID-19 and how these might affect assumed future longevity increases? So we have to finish on COVID-19, I think, as a question. Anton or Nikita, that's probably a technical one for you to answer up.
Yeah, it's interesting. Sort of up until was it 6 months ago? Most people would have said on longevity that the risk is more on the side of people living longer, and that being a not quite one-sided risk, but in terms of distribution of potential outcomes, perhaps more one-sided on the people living longer scale side of the scale. I think COVID has identified that there are, there are risks of people living less long as well as longer. So, that's just a factor that feeds into the mortality basis that you use. We've certainly seen in the UK market that there have continued to be buy in, buy out transactions, and off the back of that, longevity swaps that are being transacted. So I don't think that COVID-19 fundamentally alters, the fact that schemes have longevity risk and that there's value in insuring that risk away.
Thanks, Anton. Yeah, and I think that just does highlight the risks that are being run and that it is over long periods of time, has been highlighted. I think, Meher, you touched on that one of the real challenges for employers here or sponsors here as well, is the time frame we're talking about, and that there's admin and regulatory risk to be running for a long period of time. identifying and clearly understanding where all of these risks are and how those sponsors might want to manage it, I think is what's really been clearly brought out by the presenters here today, and hopefully given the audience plenty to think about in that way, and challenge to us all about how we actually present this to our clients to help them understand and manage those risks most appropriately. So I'd like to thank Oscar, Nikita, Mihir and Anton for a great presentation and wonderful insights into the risks that we manage with defined benefit schemes. As we're up on time, I'm sure we've still got questions coming through. I think Mihir, we've agreed, obviously, for the questions that we maybe didn't get to, we'll answer those and post answers to those along with the slides on the website through the events team. So I think with that, as we're up on time, I just want to say thank you to everyone for joining. Thank you for the questions coming through. That's great to have those. And long may us continue this debate and coming up with the solutions to the problems. That's great. Thank you, everyone. And hopefully you enjoy the rest of the conference. Cheers.
Thanks, Richard. Thank you very much. Thanks, everyone.
Bye.
Bye-bye.